earnings conference call hosted by Birlasoft Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on a touch-tone phone. I now hand the conference over to Mr. Abhinandan Singh, Head Investor Relations, Birlasoft. Thank you, and over to you, Mr. Singh.
Thank you, and welcome, folks. By now, you would have received or seen our results that were announced last evening, India time. Those are also available on our website, www.birlasoft.com. Joining me on this call this morning are our CEO and MD, Mr. Angan Guha, and our CFO, Ms. Kamini Shah. We will begin the call today, as usual, with opening remarks from both Angan and Kamini, and after that, we will open up the floor for your questions. Before I hand over the floor to Angan, a quick reminder that anything that we say on this call on the company's outlook for the future could be a forward-looking statement involving significant uncertainty, and therefore that must be heard or read in conjunction with the disclaimer that appears in our investor update, which you would have received and is also uploaded, as I said, on our website and also filed with the stock exchanges. With this, let me hand over the floor now to Mr. Angan Guha, our CEO and MD. Over to you, Angan.
Thank you, Abhi. So good morning and good evening to everyone wherever you are, and thank you for joining us today as we share some perspectives of our fourth quarter and full year FY25 performance. But before I begin, I just wanted to apologize that I'm slightly under the weather, so my voice modulation may be an issue. But if you have any questions, then I will step in and answer as and when the time comes in. So at Birlasoft, you will recall that over the past couple of years, we have undertaken and initiated several actions aimed at securing our long-term profitable growth objectives. The key among them has been investing in scaling up opportunities and capabilities that will drive our future growth. A classic example of that is our early adoption on emerging technologies like Gen AI, where we have created a solid framework and a tool that helps us to deliver to our customers. We are also using our specialized domain expertise within each of our verticals and sub-verticals, together with our technology capabilities, to create an offering and use cases that are very relevant for our customers and prospects. Another key element of our culture has been to drive greater accountability and swifter action. And towards that end, we've obviously changed a lot of leaders who've not delivered for us, and we are willing to make further changes to our teams if the need comes in. We will become a very performance-driven organization, which we have always been, and we want to continue that scale. Some of the changes that we've had in the past few months is we've refreshed our leadership in manufacturing. In the medtech segment under life sciences, we have had a new leader. We've also promoted a new leader internally to take up our digital and data business. The GCC opportunity clearly presents a very big opportunity for us. We've hired a senior leader in India to look at the GCC opportunity and how can we drive that as we go forward. Our investments in the ROW business is finally paying off. As I'm sure some of you would have noted from our deal flows, we've been able to win one large deal, a reasonable size deal considering the size of our company in the ROW region, and we have a couple of more deals in the offing that are looking very, very good. So with that, let me talk a little bit about our full year and Q4 performance. Now, FY25 has been a steady year for us, but it has clearly been disappointing, as I'm sure all of you have noted. In the face of soft demand environment owing to sustained macroeconomic challenges, and as a business, we've structurally seen a lot of project-based businesses come under a slight amount of pressure because the discretionary spend is very, very muted at this point in time. With that backdrop, our consolidated revenues for the year have grown 1.8% from the preceding year to about 5,375 crores. In dollar terms, this is about $635 million, which is, as you will notice, flattish over FY24. You may recall that we we witnessed large amount in Q3, and that also was in Q4. In addition to that, as I had mentioned in our last earnings, we also saw some project closures and ram downs in a couple of customer accounts. But I would like you to know, not lost any customers. Some of our large customers, we have seen ram downs, we have seen some insourcing, but we have not lost customers. We still continue to serve those customers and work with those customers for their future tech spend. As a result of our revenue during Q4 has declined to rupees 1,316 crores, which translates to 152.2 million in dollar terms. On the margin front, however, actions on the operations front and some one-offs have enabled the EBITDA margin to rise to 13.2% in Q4, a sequential expansion of 119 basis points. As a result, our post-tax profit was up 4.4% quarter-on-quarter to 122 crores. For us, the year under review also continued to be characterized by strong cash flow generation, and Kamini will provide more color in both the margin uplift and the cash flows in her remark. On the deal front, I'm pleased to observe that after a significant spike in total TCV volume in Q3, we recorded another quarter of sequentially increased TCV during Q4. We have signed deals worth $236 million during Q4, which is 4% higher than what we signed in Q3. More encouragingly, the quantum of new deals in TCV is up 75% quarter-on-quarter in Q4, showcasing the fact that we are winning new logos and new deals. So almost half of our Q4 total deals in TCV have come in from new deals, which augurs well for our future growth trajectory. Among the deals that we have closed during the quarter is a significant multi-year engagement with a new customer that we've added in the UK. That comes under the ROW region. You may, since being secured, that is reflected in our Q4 deals TCV. For this global communication major, Birlasoft will deploy advanced AI-powered capabilities, including agentic AI and intelligent diagnostics AI, to deliver the next generation IT services model designed to transform the customer's global technology operations through the integration of AI-driven innovation across Americas, EMEA, as well as the APAC regions. As we look ahead, and as you know, over the past few quarters, the demand environment has been challenging, marked by a lot of macro uncertainty, exacerbated by the recent news flow around the trade and tariffs. There have also been some project closures that I talked about in my earlier discussion, and we've seen ram downs as well as we've seen some insourcing, which could affect our growth performance in the coming quarter as well. However, we feel our growth will be back in the company starting Q2. At this point, I will ask Kamini, our Chief Financial Officer, to share her perspectives on the quarter and the year under review. Kamini.
Yeah. Thank you, Angan. Good day, everyone. Thank you for joining us. It's a pleasure to talk to you again. Let me take you through the financial highlights for Q4 of 25 and then for the full year of FY25. As you would recall that in our last earnings call, we had called out a couple of factors that were expected to have a near-term impact on our performance. One was the usual higher than usual furloughs that was extending into January and having some residual drag into our Q4 revenues. Secondly, as Angan mentioned, we have witnessed project closures and ramp downs in a couple of customer accounts. Given the soft demand conditions, the customers have been tending to hold back on discretionary spends. It has been challenging to meaningfully mitigate the impact of some of the headwinds. Consequently, for the quarter under review, we have registered a 5.4% decline quarter-on-quarter in dollar terms to about 152.2 million. Among all our verticals, energy and utilities registered a sequential growth of 1.8% during the quarter. The other verticals witnessed a degrowth on account of the reasons that I just mentioned. Margin performance has been better. It has also reflected some actions that we have taken to drive operational efficiencies, as well as some tailwinds on account of currency and certain one-offs. The margin tailwind has largely been account of lower variable pay and leave encashment for our senior executives and currency benefits, together accounting to about 200 bps. As a result, EBITDA for the quarter increased to 20.1 million from 19.3 million in Q3. This translates to a 13.2% EBITDA margin, which is an expansion of 119 basis points quarter on quarter. This has been achieved as we continue to invest into our business and demonstrate our commitment to optimizing and overall trying to improve our margin profile. Consequently, PAT for the quarter has increased from 13.8 million in Q3 to about 14.1 million in Q4. When we reflect back on the full year's performance, we have reported a consolidated revenue of about 635.4 million, representing a flattish growth and a marginal degrowth of about 0.3%. In rupee terms, the revenue for the year was up by about 1.8%. As you would recall, during the course of the year under review, we have made significant investments in our business, successfully secured some consolidation deals that required pricing flexibility. We have also grown our infra business that takes some time to catch up on the overall business level margin. This has had a tempering effect on our EBITDA for the year, which stood at 82.4 million, translating to an EBITDA of 13% for the year. PAT for the year stood at about 61.1 million, lower than 75.3 million in the preceding year, where we also had the benefit of a one-time insurance claim. The effective tax rate for the year was 25.8. When I reflect back on the balance sheet, I'm happy to note that we ended the year with cash and cash equivalents of 259.9 million, which has grown by 24% year on year. Compared to the preceding quarter, our cash and cash equivalents was up by 8.1%. This reflects consistent good cash generation, which is evident by our operating cash flow, which for the year FY25 has been at about 88.3% of our EBITDA. You would agree that our DSO at 54 days is probably among the best in class. We remain committed to staying focused on sustained robust cash flow generation. In continuation to our track record of prudent capital allocation and rewarding shareholders, the Board of Directors has proposed a final dividend of rupees 4 per share, subject to shareholders' approval. This, combined with the interim dividend that we had paid out after our Q2 board meeting, takes our total dividend for the full year to 6.5 rupees per share, translating to a payout of about 35%. So we have ended the year with a robust balance sheet. We are generating strong cash flows, given our ability to make more investments necessary in the business to drive growth going forward. Thank you very much. Back to you, Abhi.
Thank you, Angan and Kamini. Moderator, can you please open up the lines for questions and answers?
Yes, sir. Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question comes from the line of Ravi Menon with Macquarie. Please go ahead.
Hi, thanks for the opportunity. Again, good deal wins, but we have seen this, let's say, the offshore revenue decline from Q4FY25, where we were expecting this sharp shift on site to actually start reflecting in an offshore revenue increase. So far that doesn't seem to have happened. Could you talk a bit about this? This is because we've seen some other deals that are ramping down. Is it still a margin benefit that we expect later on? And then could you talk a bit about why we've seen this decline? That's fairly broad-based across the 3 verticals and even like top 5, top 6 to 10 and beyond the top 20 customers.
Okay. So Ravi, let me pick up your question in terms of offshore that, we've seen in fact some of our discretionary demands largely in on-site. That was coming into play, which is the reason why you've seen in this current quarter an increase as far as our on-site. But we largely remain equally balanced between on-site and offshore in terms of the differences. We had mentioned earlier saying that our offshore would increase as we translate, as we kind of consolidate. But I think that consolidation has taken a little bit time in terms of moving work offshore. So which is why you see us operating in this stage at this point of time.
And just to add to what Kamini said, Ravi, for us, this trend will continue for maybe one more quarter, and Q2, towards the fag end of Q2, you will start seeing the movement back to offshore, Ravi.
All right, thank you. And that I guess should be margin accretive, but again, kind of revenue head, it will be a revenue headwind, right, at that point?
Yeah. So on the revenue, it is hard for me to comment right now in terms of how things will shape up because there is uncertainty. So I think for us, the two big issues that have hit us, one is, like I was saying in my commentary, we've not lost an account, but in some of our larger accounts, especially within manufacturing as well as healthcare, we've seen some amount of insourcing and some amount of project closures because our clients are also, looking at the situation with a little bit of caution, and that has resulted in our revenue downtick, if you will. So we are watching the space. We feel currently as we stand, our Q1 revenues will also be muted. We are trying to keep it flat. There could be minor degrowth as well. We don't know that yet. But our endeavor would be that we get growth back in the company by Q2.
Thank you. One follow-up question to Kamini. The unbilled revenue is up a little bit, by about 3 million QOQ. Should we see this come down over time, or what could have led to this?
No, I think the reason why unbilled revenue has come down is also that we are really pushing a lot of our fixed price projects. We have started reaching our milestones and liquidating that as far as our customers are concerned. So it is more in terms of increasing the efficiency from a milestone delivery standpoint and also cash generation, eventually converting into cash. That's the only reason.
But this quarter is up though, right? QOQ?
Sorry, Ravi, we couldn't hear your question properly.
Isn't it up, unbilled revenue? Isn't it up QOQ this quarter by about 3 million?
Oh, okay, I was looking at it from a year-on-year basis. Sorry, Ravi, when I explained that to you, right? Yeah. So no, it is part of a normal trend, Ravi, nothing to be very specific about, right? We will essentially liquidate the revenue as we go along, right? So there's nothing very exceptional from that standpoint.
All right, thank you.
Thank you. Our next question comes from the line of Dipesh Mehta from Emkay Global. Please go ahead.
Yeah, thanks for the opportunity. Just want to understand about, first about margin. Now, I think you indicated about certain one-off in the margin. And if I look at employee benefit expenses, absolute term it has declined sizably. So if you can provide what were the one-off in the quarter four, and do you expect it to continue in quarter one, or it can provide headwind to quarter one margin? That is question one. Second question is about the overall revenue growth trajectory. Let's say if you look FY25, out of 3 quarters we have sequential decline, and exit is also fairly weak for us. Now entering into FY26, are we confident about, let's say, growth to resume for full year perspective? Considering whatever pipeline we have seen built up, conversion and overall client conversation, what you have with the major clients, if you can provide some sense about the growth trajectory. And last is about, now we have a sufficient cash, payout is still 35%, so we are generating good cash. How you plan to use it, particularly for M&A perspective, and what is broad thought process around it? Thank you.
Yeah. So Dipesh, let me talk about the deal flow as well as let me talk about the revenue, the way you see it today, and then I'll hand it over to Kamini to talk through the cash utilization as well as on the margin. So Dipesh, if you really look at it, and you are right, in the last 1 year, 3 quarters out of 4, we saw revenue declines. Some of them were a little unexpected. We couldn't, expect that at the start of the quarter, and it happened because we got ramp down notices from our clients. I feel that this quarter 2, the quarter 1, we will have muted revenue growth. Now the deals that we are winning, that will start generating revenues from Q2, which is why, Dipesh, I said we at least believe today that Q2 onwards we'll get some growth. I don't know how much, but Q2 will see some growth. Overall, from an FY26 perspective, our endeavor would be to deliver FY26 better than FY25. But Dipesh, you must also realize, which you yourself said, that our base revenue starts at 152, right? So we have a lot of headwind. So for me, even to stay flat for the year, it will need exceptional quarter growth going forward. How much of it we can deliver Q2 starting, I don't know. But the management team's endeavor will be to at least have FY26 better than FY25, but that could be only slightly better because of the headwind that we see getting into this financial year. On the margin front, I will ask Kamini to talk about what we have done and what we intend to do going forward.
Yeah. So Dipesh, on a specific question, right, as far as the margins are concerned and overall on the employee benefit costs, you would see a reduction in our overall employee base. So I think that's a reflection of that benefit from a lower cost standpoint that we have seen. Of course, I've also mentioned the one-offs that we had in terms of reduction in variable pay, one-time benefit to which we are seeing a reduction as far as our employee-related cost is concerned. Some of it is structural in terms of the fact that they will continue as long as our employee base remains at the same level to that extent, but some of that may come back next quarter as we restore variable pay to the normal levels. From a margin standpoint, our endeavor would be to remain flattish as to where we are at this point of time. Given the current revenue profile that we are in, we're really working to make sure that we take actions on other places to keep it at the same levels. As far as cash is concerned, sorry, on the third question, as far as cash is concerned, see, we have, if you really look at it from, from our cash allocation policy, our capital allocation policy, our dividend ranges typically between 25 to 35% of our payout, and that's what we have done over the last 2 years. We do intend to retain cash for our business investments at this point of time. So I think we will continue to operate in this policy unless there is something, there's anything different that comes into play. So that's where we would be at this point of time.
So 2 follow-up questions. First on EBITDA margin. Now earlier we always used to aspire to operate 15 to 16% EBITDA margin trajectory. We are lower this year. Even let's say your commentary indicate we will be flattish. So roughly around 13% is what we aspire to deliver in 26. So by when you expect, let's say, to revert back to our aspirational margin trajectory, which is above 15%? And second question is about case accrual. Now investment is obviously there are 2 ways investment happen. One is organic, second is inorganic. Where you expect intensity to increase in terms of next 12 to 24 months and the area identified to make those investments? Thank you.
Correct. So Dipesh, first let me tell you on the margin front. See, the reason we want to keep the margin at a flattish level is because the entire company's focus is now to win deals and get revenue. We have really lacked in terms of revenue growth. We have to get the company back to growth. And that will be our endeavor over the next 3 to 4 quarters. We will try and keep the margins at the 13% because we want to win more market share. I feel if we can get back to good growth trajectory, which of course, as you can tell, arithmetically it can't happen in FY26. It will happen in FY27. So FY27 onwards, as the growth comes back, you will see an uptick of margin. So though we don't give any guidance, we feel that FY27, FY28, you will see more increased margins once the growth comes back. Second is our entire intensity organic. Correct? We will continue to make investments. We are changing a lot of leaders. We are looking at newer capability. We are looking at newer partnerships. And those will deliver a lot more organic rhythm. Or from an inorganic perspective, Dipesh, we are obviously generating a lot more cash and hopefully we'll continue to generate cash. At some point in time when we get a great asset, we will definitely look at it. But our endeavor first rhythm will be to organically fix the company even before we look at an inorganic kind of a buy.
Thank you.
Thank you. Our next question comes from the line of Harsh Chaurasia with Vallum Capital. Please go ahead.
Good morning, sir. I have a couple of questions from the vertical perspective. So first of all, on the BFSI, where the broader IT is very positive on BFSI, and this is the only vertical which is growing for most of the players, why the growth has started to deaccelerate for Birlasoft? That was my first question. And second question is the healthcare life sciences. You mentioned earlier about the insourcing as well, but in the prior quarter, you called out that there would be some quarter of softness, but after we have even hired senior leaders for MedTech and some other verticals beneath healthcare. So wanted to understand when this will start to kick in for growth in healthcare life sciences.
Yeah. So Harsh, thank you for that question. So first, let me talk about BFSI. If you recollect, Harsh, our BFSI business predominantly is a cards and payments business and an asset management business. We don't work with banks or we don't work with meaningful insurance companies. We probably have just one or two insurance clients. Right? Our majority of our focus and our client base is either banks, cards and payments, or asset management companies. So, 12 months ago, 15 months ago, when all the other companies were not doing well in BFSI, we were doing well because the banks were not spending, whereas the cards, etc., the card companies, etc., were spending. Now the situation is reversed because the banks' spending has gone up, which is why you will see all the other companies who serve banks doing well. But a specialized company like ourselves are having a couple of quarters of, degrowth or a couple of quarters of muted growth. Harsh, you will also remember, even in the last call, I had said that BFSI now has grown for us for almost 9 quarters sequentially. It will see a couple of quarters of little muted performance, and then even BFSI will come back to growth. Now, on life sciences, Harsh, you must also appreciate that, again, just like BFSI, life sciences for us is predominantly a medtech business. I mean, we don't work with payers or providers or any of them. We are a very specialized medtech company. And medtech, more often than not, is a manufacturing business rather than really a life sciences business, which is where, because of the trade as well as the tariffs, etc., we have seen a little bit of cautious spending by the customer. But Harsh, look, we have not lost a single account. That is a positive. And I hope that over the next 2 quarters, healthcare, LSS will also start showing growth. But you have to give it a couple of quarters. We hire a very new leader from a tier 1 company. Give him a couple of quarters to settle down. But I'm reasonably confident that, we will drive growth in our medtech portfolio very soon. Just so that you know, we've been down selected as a preferred partner for a large medtech company in America, and I'm very positive as quarters go by, you will see some good uptake there.
Got it. Thank you. Thank you very much, sir.
Thank you. Our next question comes from the line of Sandeep Shah from Equirus Securities. Please go ahead.
Yeah, thanks. Thanks for the opportunity. Again, the question is more strategic. So I think you joined 2 years back, and we have already done a significant amount of restructuring in terms of turning the leadership, investing in capabilities, expanding partnerships. But the revenue growth has been really marginal over the last 2 years if I compare FY25 with FY23. So in your analysis and postmortem, what is going correct and what is going wrong, and how do we plan to change? Because I think leadership churn has already happened in the last 2 years. So is it more industry specific, or is it more a Birlasoft specific, where correction is still need to be done in a significant fashion going forward to avoid such kind of year ahead? Because FY25 has been one of the weakest years for Birlasoft.
Yeah. So Sandeep, thank you for that question. So look, FY23 and FY24 were reasonably good years for us, right? I mean, we delivered good growth. It is only in FY25 that we've had a flattish growth. And of course, since the operating leverage did not play out, our margins showed a negative trend, as you know. But look, Sandeep, I mean, I'm here to only build a company for the long term. We will continue to invest. We've made a lot of changes. We made a lot of changes at the leadership level, at the account manager level, at the capability level. We are also building a lot of partnerships. It will take a little bit of time. Unfortunately, because of everything that is happening in the macroeconomic situation, all our investments are not yet playing out. Like I said, some of our customers, and I can't name them, but at least 3 of our customers between manufacturing and healthcare have decided to ramp down a lot of projects, insource a lot of work. That is affecting us. But I still feel our investments are in the right area. Of course, we have to continue to hire some leadership, as you know. I mean, we have some leadership vacancies that we will continue to hire. But we will not cut back on investments, Sandeep, because I feel our investments are in the right area. We may take a little bit of a hit on margins for a year or so, but our entire endeavor is to get the growth back. That is what we'll be focused on. I hope Q2 onwards the growth comes back, but we will see. We will see how this thing shapes up.
Yeah. Just a related question. If I look at the deal TCV this year in terms of both total as well as new business has not been that great, though Q4 has been really good. So don't you believe we need to be proactive in terms of A, increasing the deal pipeline, B, in terms of converting the pipeline into deal wins, which will help us in terms of compensating a leakage in the existing book. So are we doing any restructuring in terms of creation of large deal pipeline, converting pipeline into deal wins, and to actually avoid such unforeseen circumstances?
Yes, Sandeep, very good question. So if you look at our Q4 deal wins, out of the 236 million that we delivered, almost 112 million is new, right? And that is unprecedented. We've never had almost 50% of our deal wins with new. So that gives me a lot of confidence that the future will look bright. Not maybe the immediate future, but over time we can fix the company because structurally we are a strong company. To your second question, we've identified an existing very senior leader to take the mantle of opening accounts, and we've identified about 19 or 20 accounts that we're going to go after so that we can create pipeline and close them. Obviously, that will take a little bit of time, but we are well within that direction. So Sandeep, our entire endeavor over the next 4 to 8 quarters is just to focus on the market, pipeline, and deal closures. That is important. If we can get that right, the others will get fixed.
Okay. And just a last follow-up question. I think in the earlier quarter earnings call, you said there are 2 or 3 larger deals. One we have already closed in the fourth quarter. Any update and progress in the balance 1 or 2 large deals which we are chasing?
Yeah. So, Sandeep, thank you for asking that question, and I want to make it very clear. See, another large deal with a high-tech company in the US we've closed. That is also in the range of about $30 to $40 million. We are very close to closing another financial services deal in Europe, which will also be another 25 to 30 million. So these 2 deals you will see in Q1. The only thing I will say is in Q1, since we don't have any renewals, the overall TCV will look muted, right? So for example, the overall TCV in Q4 is 236. I don't believe in Q1 overall TCV will deliver 236. If you remember, typically in our kind of company, the first quarter we deliver about 140 to 150 kind of deals. This year it may be slightly better because of the 2 new deals that we have closed. But I'm reasonably confident that this year my overall year TCV will be better than last year's TCV. And last year also, Sandeep, we delivered about $735 million worth of TCV to FY24 at 837. That was pretty much one deal, $100 million deal that we had got. So I'm confident that we'll do better than 735 for the year when it comes to signings, but it will gradually ramp up. Q1 will be slow, Q2 will be better, Q3, Q4, like always, will be much better.
Okay, thanks. I will come in the follow-up if I have more.
Thank you, Sandeep.
Thank you. Our next question comes from the line of Abhishek Shindatkar with InCred Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. My first question is regarding, we historically had a high percentage of project nature of the business. Can you quantify what that number is today, and is it also a reflection of our revenue volatility because of the discretionary spending challenges?
Yeah. So, Abhishek, if you look at our overall business, right, roughly our discretionary spend and project-based business contributes to about 70% of our overall revenues. Now, that is why when the discretionary spend gets cut, we are in the situation that we are in. But if you look at the last quarter, I mean, we won a lot of multi-year deals. right? Which is more annuity-based deals, and the 2 deals that we will win this quarter will also be annuity-based deals. So it will change our situation a little bit. But our project-based business will not go away. It will still continue at that 50-60% range. It is 70% today. Our endeavor will be to take it down to at least 50%, and 50% business which is more annuity-based. Right, so that will be our endeavor now, but that will be a journey, Abhishek. It will take a couple of quarters to get there, but at least the initial indications are the kind of deals that we are winning are all multi-year annuity-based deals.
That's helpful. Just follow up to the answer. If I remember it correctly, when around 2021, the numbers that were shared that the annuity component has slowly risen from 50% to 65%, but the number that you're sharing today is that project is 70%. Did I miss anything, or maybe those numbers don't time?
Yeah. So Abhishek, look, 2021 was a very different year because of the COVID year. We got a lot of annuity work at that point in time. It all depends upon how you classify. Today we are classifying annuity work in terms of where we will be using agentic AI to kind of disrupt and deliver new age delivery to our customers to help them. So I was more referring from that perspective, right? So over 21 to 25, absolutely, our annuity business has actually gone down. The project business has gone up. If you remember, even in 23 and 24, we talked about projects that we were able to win, which is short-term projects, where we would deliver for about 6 months to 9 months and walk away. Now, slowly we are trying to, get away from that and win more annuity work. But it is also a manifestation of the kind of clients we serve. If the clients want us to help them in a particular project, which is 6 to 8 months, then we definitely go in and work with them. So you have to give it some time, Abhishek. We clearly understand that we have to get more annuity work and probably get it back to the 70-60% that we once were. We are working towards that.
Very helpful. Just the last question from my side. Given that you're reporting now, you must have seen, the first 2 months, how have they played in terms of, conversion in the pipeline. Many of your peers, when they reported in April, highlighted that from March onwards, they have seen a material slowdown in terms of conversion, or there have been pauses. Given, things have improved, both from an administration perspective, given that they are more reconciliatory right now, what is your assessment of the past 2 months, especially the month of May? Has it seen any changes in terms of, conversions of the booking, maybe for you and also for the industry?
Yeah. So Abhishek, again, thank you for asking that question. See, like I was saying, our manufacturing business is roughly about 160-170 million, and our medtech business, which is also manufacturing, is roughly about $100 million. So technically, about 300 million, give or take, is very manufacturing dependent, which is prone to tariffs and everything. Which is why I said that for us, at least the clients that we serve are trading cautiously, though the administration's views have softened a little bit. But it's a wait-and-watch policy because people have not seen it. Which is why, Abhishek, we also felt, considering that we are already closer to 1st of June, I don't see Q1 being a growth year for us. We, like I said, I think to Dipesh earlier, we'll try our best to stay flat, but I must say that we may also deliver slight negative growth. But I'm confident that Q2 onwards, the growth will be back, only because based on our client conversations, people are hoping that in another couple of months, things will become far more clearer, and the projects that we have won or are winning will start showing revenues Q2 onwards.
Very helpful. Just a quick follow-up. For the industry, you think that the pipeline conversations would be high, but are the conversions changing after, the administration or the soft stance of the administration, especially in the
Yeah, I feel, and for us, US is very important because it's 87% of our business. I feel that would probably take a couple of more months to get a lot of clarity on. I can't talk about the industry in general because it also is a manifestation of the clients that they serve. But the 40, 50, 60 clients that we serve, which are our bigger clients, and the other 150, 200 smaller clients that we serve, at least the sense that I'm getting that there is some amount of cautious optimism. It will take a couple of quarters to get full clarity.
Perfect. Very helpful. I'll get back in the queue. Thanks, sir.
Thank you.
Thank you.
Ladies and gentlemen, a reminder to all participants, if you wish to ask a question, please press star and 1 on your touchtone telephone. Our next question comes from the line of Girish Pai from Bob Capital Markets. Please go ahead.
Yeah, thanks for the opportunity. Angad, you mentioned that there are still some gaps in leadership and gaps in capability building. Where exactly are these gaps?
So one is, Girish, we are spending a lot more in our front-end sales. We will ramp up our SG&A a little bit, though we will look at the cost reduction in our functions, but we will clearly be investing in sales. So we will put in more focus there. I think like Sandeep was asking, we will focus on net new. So we are hiring a team to focus on accounts that we are not present in. We've identified about 19 or 20 logos in the US and some logos in Europe that we will go after. Some of the deals we can talk about as we close between June and July. So that's another area that we are going to keep investing in. From a capability perspective, clearly our ERP business has not done well. The two businesses that have done reasonably okay are digital and data and infrastructure. But infrastructure is a margin diluter. It is very important that our ERP business comes back on track. So we are making some more investments on our ERP space, and when I'm ready to talk about it, we'll announce it.
Okay. I had a question for Kamini. You mentioned about 200 basis point of a positive impact in the quarter, if I remember that number correctly, because of lower pay, currency, and I think some pay due to senior employees. Can you kind of break this down as to what is one-off and what will kind of be there in 1Q?
So, Girish, thank you for the question. If you really look at it from a currency benefit standpoint, it's about 50 bits that we're talking about. Currency has been a little soft, so maybe part of it would continue into Q1. And if you look at the remaining part of it, it's by virtue of low variable pay to senior executives. So we do expect half of it to be one-off, and maybe half of it may come back on it. Some benefits on leave encashment that we've also got in the last quarter, that may actually be one-off in the true sense. So if you ask me, effectively, I would expect that we might be able to recoup back maybe 50%. The balance of it would be truly one-off.
Okay. There was also some mention about consolidation deals that you won because of some pricing flexibility that you've shown. Does this mean that project profitability on these deals will be lower than corporate margins, at least say for the next few quarters?
Yes, Girish, and we had spoken about that in one of our earlier calls, right? Because, from a consolidation standpoint, we had taken in some of these deals in place, and it would take us some time. That was one of our strategy to move them a little bit offshore to improve the margin, but that has been a little slow. So yeah, for the next couple of quarters, it would be a little soft compared to the overall corporate margin. And then we do expect to use agentic AI and some other technology to be able to recoup the margins back.
Okay. My last question, Angan, US has changed the China tariff from 145% to 30%. Has that changed anything in your customer conversations? Is there a slightly higher amount of optimism around demand?
Yeah. So, Girish, obviously it is cautious optimism because the trade tariffs is also limited to a particular time. We need to see how it goes. But again, like I said, as the companies that we serve, some of the companies who've got a larger China exposure are feeling a little better about it. So we believe that demand will come back in Q2. But really should have to wait and watch because these things can change dynamically very, very quickly.
Okay, thank you.
Thank you. The next question comes from the line of Manik Taneja from Axis Capital. Please go ahead.
Hi, thank you for the opportunity. While you clarified on the one-offs in Q4 and you're talking about the intent to essentially invest in your sales team to essentially open certain must-have accounts. In that backdrop, Angan basically just wanted to understand, should probably we be thinking about further dilution in margins in FY26 from the current levels? That's question number one. The second question was in regards to the client metrics. Over the course of last few years, you've kept on cutting the long tail of your customer accounts and trying to focus on a smaller subset of customers. Now, is that intent to essentially once again open certain must-have accounts? Should we be thinking about an expansion in terms of the client base and how should we be thinking about it?
Yeah. So, Manik, from our perspective, we still serve almost about 200 or 250 odd accounts, right? So the new must-have accounts that I spoke about is a combination of certain accounts where we have an MSA already. We have to just go and mine those accounts, reintegrate the MSA, and start doing business with them. So that is one. And second would be that, some of the large logos that we do not work with, we want to start working with. But our overall set of accounts will still come down. I don't think we want to serve more than, let's say, 250 logos in the long term. So while in the short term we may add some logos, but we will also drop some logos which are unprofitable. Like you mentioned, over the last 24 to 36 months, we've really pruned down our account list. Almost we had 600, now we have 250. We'll continue to prune them down. But certain logos that we think that we want to work with, we will add on to our list.
Sure. And just one last one.
The overall list will not change. Overall number will still keep coming down, Manik.
Okay. And if you could answer that question on margin outlook, then I have another follow-up question as well.
Yeah. So, Manik, I think your question was, as we invest, would there be a dilution of margins? There might be a temporary dilution. The idea is to create space for these investments within our current margin profile. So, we're not going to let that significantly impact our margin. Maybe a quarter or so, it might take us some time, but the investment, while the reductions happen elsewhere. So, largely from an overall philosophy standpoint, it will not be at a dilution of margins. That's what I wanted to call out.
And just to add to what Kamini said, Manik, we do not want to dilute margins further. Like Kamini said, we may have some margin impact in the immediate quarters when the deals come up and we start executing. But our overall direction is clear that we need margin upliftment as we go forward.
Okay. So the other question that I had, if I'm looking at your client metrics, if I'm looking at your revenue performance by vertical, it appears it's almost a very broad-based revenue decline that you've seen across industry segments over the course of second half of this year, as well as in terms of your top client revenue performance. So it would be great to understand what exactly is it, some amount of faltering in terms of execution that's caused us, because in the course of last 18-24 months when you were doing well for a certain amount of time, you credited the success to your in-quarter execution. So where have you basically faltered in the course of the last 2-3 quarters to essentially put up a broad-based decline across industry segments or across client portfolios?
Yeah. So, Manik, again, a great question. So let me clarify this. I don't think we've lost any client or any project due to execution issues. I mean, of course, there are delivery challenges which happens in every company in various areas. But broadly, at a company level, I think most of our customers are very satisfied the way we work with them and what we deliver to them. Right. So that is point number one. I also mentioned that we have projects have come to a close. the ramp downs that happen, and in certain cases, as companies build up their own GCCs in India, some of the work has got insourced. But that is because of their strategic reasons, not because of our execution reasons. On the topic of broad-based revenue ramp downs, that is, like I said, about $300 million out of our $650 million is really manufacturing in nature. In fact, a little bit more. Even in our high-tech business, probably some of the accounts that we work with are manufacturing. And manufacturing is a large part of our business, which has had the biggest win, if you will, in their own businesses. Now, BFSI, I feel, is a spot problem. Over time, BFSI will be back to growth. Energy utilities, like Kamini said, is still growing. We just have to fix this manufacturing bit to get this back to growth. If we can get that back to growth, I think our woes will go away, and that is what we are focused on.
Sure. Thank you, and all the best for the future.
Thank you.
Thank you. Before we take the next question, a reminder to all participants, you may press star and 1 if you wish to ask a question. Our next question comes from the line of Sandeep Shah from Equirus Securities. Please go ahead.
Yeah, thanks for the follow-up. Kamini, just a clarification. So out of 119 bits impact on the margin in the first quarter, we are saying roughly half of that could be a headwind and may not repeat because of one-off nature in the 1Q of FY26. Is it right?
So Sandeep, just to clarify that, I was talking about the 200 bits that we said were one time. So out of it, maybe 100 bits may not reoccur. From a structural standpoint, though, we will see how we can make that up as far as Q1 is concerned. So 200 bits.
Okay. So directionally, 1Q margin could be slightly lower on a Q1Q because of this.
Yes, Sandeep, as of now. But like I said, that we are driving operational efficiencies to see how we can make that up.
Okay. And then just a last question, if I look at the practice-wise revenue growth. So the major drag in the revenue in FY25 has been through ERP, which has declined by closer to 6.4% on a YOY. So while most of your larger peers are talking about increasing demand in terms of upgradation of on-premise to the cloud version of the ERP, both on SAP and Oracle, so why same is not witnessed by us? So is it a portfolio-specific issue, or is it we work with more of tier 2, tier 3 in terms of ERP versus tier 1 accounts, and that is not driving the growth?
Yeah. So, Sandeep, it's a combination of both. First, you're absolutely correct. We work with tier 2, not tier 3, but tier 2 and slightly lower and with the tier 1 manufacturing companies. And the uptick that you see in SAP and Oracle movement to cloud like S4HANA or Oracle Fusion is probably helping the larger companies to begin with. But I can tell you, slowly over the quarters, over the next year or so, it will start improving the smaller companies like ourselves, which are very heavily ERP focused. That's point number 1. Point number 2, while our ERP business for 2 years have actually degrown, not 1, 2 years, we are making some structural changes here, Sandeep, and I would like to probably take that offline in terms of what we will do. But there is a lot of focus to get the ERP business back on track. And over the next 2-3 quarters, I will come back and update you what we are doing there.
Okay. Thank you and all the best.
Thank you. Our next question comes from the line of Ravi Menon from Macquarie. Please go ahead.
Thanks for the opportunity. Again, the whole Invacare deal had been, I think, a great client reference, possibly at that time, and that is the largest multi-year deal that you guys had won. Are you looking at something like this where significant cost takeout, total IT outsourcing set of opportunities, if that is with these companies outside the Fortune 500?
Yes. So, Ravi, we have a couple of deals in the hopper where we are doing cost takeout deals. But look, our endeavor right now, apart from cost takeout, is to do a lot more domain-related deals. I don't think we'll have too many deals in the $100, $200 million range. The industry is also changing. We have a lot of $30, $40 million deals now, which is in our sweet spot, which we are winning, where we are, working with our customers to deliver services using agentic AI, and the customers are going to pay us on story points rather than pay us on fixed price outcome of people. So that's a big shift that we are seeing. But to answer your question, we have got a couple of deals which are large and which are cost takeout. I don't know whether we will win them or not, but at least we are pursuing them.
Thank you. Best luck.
Thank you. Ladies and gentlemen, that was the last question for the day. As there are no further questions from the participants, I now hand the conference over to Mr. Angan Guha, CEO and MD, Birlasoft Limited, for closing comments.
Yeah, thank you. So first of all, I would like to thank each one of you for your interest in Birlasoft, for the time that you have taken to spend with us today, and for the questions, which I always find very, very insightful. The only message I want to leave on the table is, look, I know that FY25 was a bad year. We accept it. But my only commitment to all of you is we will try and make FY26 better than FY25, even though if it is slightly better. Second is, the other message I want to leave on the table is that fundamentally and structurally, we are a solid company, and our cash flow generation year over year proves that. Our DSOs are at a meaningful level, and we have no debt on our books. So fundamentally, we are a very, very strong business, and all we need to do is to get the growth back into the company. And on behalf of the management team, I can commit that that's the only focus that we have going forward. But thank you for your time, and I look forward to speaking to you next quarter. Thank you.
Thank you. On behalf of Birlasoft, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.